Hello guys, welcome to this particular session. Hopefully this video won't be long. I just wanted to bring a number of issues to your attention. As a trader guys, it's very important to ensure that within your trading arsenal you have tools such as your risk profile in place. Why? Because it's very important as a trader or as an aspiring profitable trader to ensure that you preserve your equity. So one way to do that, or to effectively do that, is to have a predefined risk profile before you open any position on your live account. All right, because I'm of the belief that before we even become a consistent profitable trader, you need to be a very strict risk manager. It's very important to ensure that in the long run you do not blow your account and you do not lose a lot of money unnecessarily. Okay, why do we need to have such in place? This helps us to jump into any position setup that we see. This helps us to build our confidence, because with consistent positive results, our confidence also grows as a trader, and then it also assists us in keeping our emotions out of every decision that we make, either on an open trade or the decisions that come around when you actually have to open a particular trade. And then how can we achieve all these things, guys? It's very important. You must have a trading plan with a risk profile, or you must have a trading plan and a trading profile. You must ensure that at every time you trust the plan. That means that you don't deviate from what you have said before yourself, to say that I'm going to follow this particular rules. Don't deviate from them regardless of what the market do. Stick to the plan. All right, and don't think that you won't have losses. You would have them, a lot of them. But if you have a plan in place and then you have a risk profile in place, those losses to you, they would come, but they would not tamper with your emotions. They won't even steer you to deviating from the plan that you have set before yourself. So all this is working out to assist you as a trader to grow, and then to ensure that in the long run you become very profitable. All right, the elements of the risk profile should include, but are not limited to, the following. You should have what we call the risk reward ratio in place. For me, that's basically saying that for every dollar that you risk, you stand to gain $2. And then number two, that's your equity exposure. How much of your account balance are you willing to expose to the market? I stick to 2%. That works for me. And then the position size, that is the lot size. I would show you in a very short while how we can actually work out your position size. You don't just pick any random lot to use on your account, guys. You should do this in line with your account balance. And then what is the pip value that you can basically use? We can also work that out in a very short while. And then how do you manage your open trades? Are you using break even as a way of managing your trades, or are you trail stopping your price as it moves in your direction or not? And then the time frame where you open and close your position is very important as well. For me, I use higher time frames for my analysis, and then I enter on lower time frames. You can work that out for yourself as well. All right, let's go to the market and see how this would play out for us. All right, we are here on Trading View. I'm looking at the euro dollar on the 30 minutes time frame, and then let's assume that we are anticipating a short position, the market trading down, and then at this pullback we anticipate to enter again to go down. So we basically have this tool delineated here to say that we would be entering the market as it pulls back into this particular candle, or in line with this candle at this particular point. This would be our entry, and then our stop loss would be above this particular high, and that gives us 13 pips in terms of risk, as compared to our gain, which would be around about 40 pips. So our risk to reward basically at this point, it's 1:3. Yes, it's 1:3, right? Oh, there's the text that I'm looking for. Yes, and then this should be something that you define for yourself. It should be in line with your trading plan. You don't just pick any target or any point where you say that you would be going out of your position at this point if the market goes against you. It should be in line with your trading plan. Okay, so for argument's sake, let's say that we have a $500 in our balance as our balance, and then our risk of this 500 balance would be we are going to risk only 2% of this particular balance, which I believe should give us around about $10. Yes, and then our risk to reward, for instance, let's say that let's stick to 1:2. 1:2. Our risk to reward should be 1:2. Yes. All right, and then we have our stop loss would be $10. As we have said, we are risking only 2% of the account. Yes, so that should give us $10. If the market moves against us, we stand to lose $10. And then what is our pip value? Holy moly, what's happening to my typing today? All right, pip value should be it should be saying that we take our $10, we divided it by what was our stop loss? 13. Yes, 13 pips. Yes, 13 pips, and then that should give us around about 0.76. Yeah, 0.76. So it means that every pip would draw out of our account around about 76 cents. Yes, so every pip would be 76 cents in monetary value. So the last part would be our lot size. How do we work that out? Lot size would be, let's move on to the calculator. Let's come to my FX book. They have a very pretty easy to use calculator here. Let's put in 500 there because that's our balance. We want to risk 2%, and then our stop loss in terms of pips. Our stop loss in terms of pips would be 13, and then this says to us that we would be trading the euro dollar. Yes, there we go. It says that we are going to lose $10, and then the lot size that we can use for every open position should be 0.07. So our lot size would be 0.07. Yes, that's that. So it means that for every position that we open as the market trade, as our setup comes to us, we would use 0.7 in terms of our pardon, in terms of our lot size. Once this is defined for you as a trader, it helps you to preserve your account. It also helps you to be consistent. It also builds within your confidence as a trader, because once you see this play out as you planned, that should do something to your confidence as a trader. Let me bring one example to show you that even with a number of losses, it's still possible to remain profitable as long as you stick to your predefined risk profile. Let's say that we have a 40% win rate, right? 40% win rate. For instance, out of 10 trades, we have only 4 wins. 4 wins of around about, we're using 1:2. We have 4 wins of 1:2. That's a reward of 8, right? And then we have losses. We incur losses of, we incur 6 losses. That says to us that we have risked, or we have lost 6. All right. Removing that 6 from our wins, it gives us the reward of only 2. So it means that our account has grown by 2%, if I'm not mistaken. It means that our account has a positive outlook. After taking those 10 trades, our account has grown from that particular point. So the number of trades that you lose as compared to the number of wins that you have, you can still be profitable if you have more losses with fewer wins. So it's very important, guys, to ensure that you have your risk profile in place, and then you use it as much as often, and avoid deviating from your own rules, because that will end in tears, as some people would normally say. We don't want to see you complaining in the channel and on other forums that, oh guys, I've blown my account. What is it that I'm not doing right, and what is it that other traders are doing that I don't do as well? All right. Guys, that'll be all for today, and thanks for watching. I would really appreciate your feedback in the comments below, or even in the Telegram channel. Tell us what you think. If there's anything that you feel that we did not include, please share with us so that we can also help other growing traders. All right, thanks for watching, guys. Bye bye.